it's hard to say whether or not we're going to have a pullback from here. I mean, certainly the market is due for a pullback. I mean, we've come a long way. In fact, year to date, the price of gold is up 54%. I mean, that is a huge move. First of all, the year's not even over yet. We still have most of the fourth quarter left. But the last time gold was up this much in a calendar year was the 1970s. Now, that was a very significant time period. And by the way, silver rose today by an even greater percentage. It actually traded above $49.50 at the high. As of this morning, or right now, it's back below $49. I think it's trading around $48.80. But the intraday high, it got above $49.50. So very close to $50, which is that key level for silver. But if you have to go back to the 1970s to find a year where gold was this good, and of course, it's not like gold had a bad year last year. Gold had a great year last year. It's just having an even better year this year. And of course, a 54% move from where gold was, dollar-wise, is a much bigger move. Think about the value of that move, because you're talking about a metal that's already, mid-2000s and moving up to 4,000. That's a big dollar value of the rise in what all the gold is worth. But if you've got to go back to the 1970s to find something like this, that probably means that what is happening now is likely as significant as what happened then. Now, what happened in the 1970s? You got to understand this, because it was 1971 that Nixon took us off the gold standard. It was supposed to be a temporary move, but it's now been better than 50 years, and we didn't go back on it. But that was a very significant development, because up until 1971, if central banks in Europe or anywhere held US dollars in reserve, which they did, they knew that whenever they wanted to, they could take those US dollars back to the US government and exchange them for gold. It was a fixed rate. If you had $35, you had an ounce of gold. The Federal Reserve note was basically a receipt that paid the holder of that receipt an ounce of gold. You had $35, you could turn them in and you could get an ounce of gold. Now, in the meantime, you could take those $35 and buy US treasuries and earn interest, which is something you couldn't do on your gold. But by allowing the Federal Reserve or the US government to hold your gold, which is basically what the world was doing, right? We were the custodian of the gold, right? So Germany or Italy or France or the UK, they hired the US government to hold custody of their gold. And we issued them a warehouse receipt in the form of US currency that represented, a pay to the bearer on demand. Now, of course, at one time, everybody, right? You didn't have to be foreign to convert your paper into gold, right? The initial Federal Reserve notes before 1933, right, were redeemable in gold by everybody. So an American citizen that had $20, because back then the official price of gold was $20. So if you had a Federal Reserve note for $20, you could take it to the Federal Reserve and they'd give you a $20 gold piece, right? It was an even exchange. So that piece of paper represented an IOU for gold. In fact, that's what gave the paper the value. It was the gold that backed it up. Now, 1933, after Roosevelt, told everybody that to turn in their gold and made it illegal for Americans to own gold, Americans couldn't convert their notes into gold, but foreigners could, right? It was only American citizens that couldn't get the gold. But if you were a foreign holder, you could still get gold. Now, Roosevelt devalued, so now you needed $35 to get an ounce of gold, not 20. But if you were outside the United States, if you were a foreign central bank and you held US dollars, you were still able to redeem them. In fact, the pieces of paper weren't dollars. The gold was the dollar. The dollar was defined as a weight of gold. The Federal Reserve note, which was the piece of paper, is an IOU for dollars. The dollars were gold. Now, they were also silver. And in fact, while it was illegal for Americans to own gold, it wasn't illegal to own silver. And so they had silver certificates. The Federal Reserve issued currency backed by silver, and you were able to get silver up until we took the silver away in 1963, 1964, and then we took all the silver out of our coins. But you were able to get silver because you could take a dollar bill and get 4 quarters, and those 4 quarters were silver, right? So you were able to exchange your paper dollars for silver just by going to a bank and getting change, right? And you can get real money, you can get real dollars, you can get silver dollars, right? The Federal Reserve note was an IOU. In fact, if you read what it says on the Federal Reserve note, it doesn't say it's $1 or $5 or $10. It says pay to the bearer on demand, $10. The $10 is a weight of gold or silver, and so it's an IOU. So, but up until 1971, these foreign central banks who were holding U.S. dollars were really holding gold. They were just storing it in the U.S. in Fort Knox. They were storing their gold, and we gave them this IOU. But what they were able to do with that IOU was purchase U.S. Treasuries. So now they can earn interest on their gold because their gold was, they still own the gold.
Let's be honest. It's hard to look at a chart of gold right now and not feel a little dizzy. I mean, it's up more than 50% year to date, 54% to be exact. That's not a typo. We're talking about a market that's gained more than half its value in less than 1 year. And the year isn't even over yet. It's been the kind of move we haven't seen since the 1970s. Now, if you're thinking, Peter, surely we're due for a pullback, I wouldn't argue with you. The market is extended, sure. But when you see moves like this, it's not just a speculative rally. It's a symptom of something much deeper. Because gold doesn't explode higher for no reason. It's the canary in the monetary coal mine. Let me put it this way. Every time in history when gold's made a move of this magnitude, it's been a reflection of a breakdown in confidence. In currencies, in governments, in central banks. And right now, all three of those are under stress. But before we get into the why of it all, let's appreciate just how massive this move has been. Gold's already smashed through record highs in virtually every major currency. It's not just the US dollar. Gold is at or near all-time highs in euros, yen, pounds, yuan, rupees, pesos, you name it. If you live anywhere on the planet, your local paper money buys you less gold today than it ever has before. That tells you something universal is happening. And then there's silver. Oh boy, silver has been on fire. It actually traded above $49.50 intraday earlier this week, just a breath away from that psychological $50 mark. To put that in perspective, that's the same level silver peaked at in 1980 during the Hunt Brothers squeeze, and again briefly in 2011 when the Fed's QE mania was in full swing. Every time silver flirts with that level, history trembles a little. Now let's go back in time because this isn't the first time we've seen a setup like this. You have to go back to the 1970s, the last period in history where gold performed this strongly in nominal terms. And guess what? The macro backdrop then looks eerily familiar today. Let me paint the picture. In 1971, Richard Nixon, in what was supposed to be a temporary measure, took the US off the gold standard. He famously said, "Your dollar will be worth just as much tomorrow as it is today." Spoiler alert, it wasn't. 50 years later, that temporary measure is still in place, and the dollar has lost over 85% of its purchasing power since. But you have to understand why that moment mattered. Up until 1971, the US dollar wasn't just paper. It was a warehouse receipt for real money, gold. If you were a foreign government or central bank holding dollars, you could take those dollars to the US Treasury and redeem them for gold at a fixed rate of $35 per ounce. That system, established after World War II under Bretton Woods, made the dollar as good as gold. Literally, it was a claim on physical wealth. Think about it like this. Back then, the Federal Reserve note was not the dollar. The note was a promise to pay dollars, and dollars were defined as a weight of gold or silver. You didn't hold dollars because you liked paper. You held them because they represented gold held in custody at the US Treasury. Now here's where things started going wrong. After World War II, the US started running persistent deficits. First to rebuild Europe through the Marshall Plan, then to fund the Vietnam War, then to pay for Lyndon Johnson's Great Society programs. The problem was the rest of the world could see what was happening. Foreign governments, especially in Europe, realized the US was printing more IOUs than it had gold to back them. So they started calling in their chits. France was one of the first to act. In 1965, Charles de Gaulle sent the French Navy to New York Harbor, literally, to load physical gold onto ships in exchange for dollars. Imagine that. The French Navy pulling up to Manhattan to collect bullion because they didn't trust the Fed's paper promises. And they weren't alone. Germany, Switzerland, and even the UK began redeeming their dollars for gold. The US gold reserves started draining rapidly. By 1971, Fort Knox had bled down from over 20,000 tons to just over 8,000, where it supposedly remains today.
When we went off the gold standard, that was a major disruption of the world monetary order, and it led to a major devaluation of the US dollar, not only relative to other currencies like the Deutschmark or the Swiss franc or the Japanese yen or the pound sterling, but against gold. Because prior to 1971, if you held dollars, you held a currency backed by gold. After 1971, if you held dollars, you had a currency backed by nothing. Now, clearly, a currency backed by nothing is not as valuable as a currency backed by something, especially when that something is gold. So the world marked down the dollar because we changed the rules. We told everybody that you're not going to get your gold. We basically defaulted. When they talk about how, the US government has never defaulted, when they talk about the debt ceiling, we've never defaulted on our treasuries. We defaulted on Federal Reserve notes. The reason that a Federal Reserve note is called a note is because it is a promise to pay, right? What does the Federal Reserve promise to pay? If you own one of their notes, what are they promising to pay you? Well, initially, they promised to pay you gold, right? They promised to pay you real money, lawful dollars. That's what the promise was. But now, the Federal Reserve notes are notes for nothing. It's an IOU nothing. It just says this note. It doesn't say what it's redeemable in. So we defaulted on those notes. The world held our notes because we promised to pay gold. And then we told the world, we're paying nothing. I mean, we didn't even say, we'll give you 50 cents on the dollar, 25 cents on the dollar. We told the world, we're giving you nothing, right? We're not giving you any gold for these notes. It was 100% default. Now, of course, we said, you're free to hold on to those dollars. They're just not backed by gold anymore, right? And so the world held those dollars, but at a much lower rate. And that's why prices went up so much. I mean, the reason that oil went from $3 a barrel to like $35 a barrel, right? More than a tenfold increase. And we like to blame that on the Arabs, right? Oh, those Arabs, they jacked up oil prices. We had this oil shock. It wasn't the Arabs. It was us. It was America. We tried to screw OPEC over because when oil was $3 a barrel, we paid them $3 backed by gold. So they were getting gold for their oil. Well, after we defaulted, we were paying paper. And so OPEC said, well, if you're going to pay us paper, well, we're not going to sell you oil for $3 anymore when we can't get any gold. And so the price went up because we paid them in paper instead of gold. If you look at what happened to oil prices in terms of gold, the real price of oil went down. It's just that because we tried to screw OPEC over by giving them pieces of paper instead of real money. And they said, okay, if you're going to give us paper, we'll take it, but we need $30, not $3, right, to make up for it. And that's what happened. Right, all these prices went up, but gold had these big moves because the dollar was being devalued because we, America, we went off the gold standard. Now, the world continued with the dollar standard, meaning that the US dollar continued to be the primary reserve currency around the world and the main currency used in international trade, despite the fact that it was no longer backed by gold. So the world didn't go off the dollar standard, but it devalued the dollar because it was no longer as good as gold. It was something less.
So let's pick up right where we left off, because this isn't just some nostalgic trip through monetary history. What's happening right now is the direct consequence of every bad policy choice made since 1971, playing out in real time. You can't print your way to prosperity forever. Eventually, the bill comes due, and gold is the invoice. Now, people keep asking me, Peter, do you think this gold rally has gone too far too fast? I laugh because that question tells me they don't understand what's really happening here. Gold isn't going up. The dollar's going down. The chart you're looking at isn't a gold rally. It's a fiat failure. Think about it. The dollar, the euro, the yen, they're all being inflated away by central banks that have painted themselves into a corner. Rates are supposedly high, yet inflation hasn't gone away. Governments are running record deficits in the middle of an expansion, and we're supposed to believe they'll suddenly become fiscally responsible when the next recession hits? Please, politicians don't cut spending, they print the difference, and gold, as always, is just doing what gold does, revealing the truth. Now let's talk about silver, because silver is the wild card in this whole story. I mentioned in part 1 that it's been knocking on the door of $50. That magic number that sent traders into euphoria back in 1980 and again in 2011. And every time silver gets near that level, you can feel the tension in the air. Why? Because silver is the Achilles heel of the paper money system. You see, gold is the king of money, but silver is its twin brother. More volatile, more industrial, and far scarcer than people realize. There's a reason it's been called the poor man's gold. But here's the thing. There's not enough of it left for the poor man to buy. Most people don't know this, but the US used to have billions of ounces of silver reserves. We had silver dollars, silver certificates, even silver in our coins. By 1964, we had drained so much silver out of our currency that we literally ran out. The government melted it, sold it, and replaced it with copper and nickel. And now, 60 years later, the industrial world is consuming silver faster than miners can dig it out of the ground. It's used in solar panels, electric vehicles, medical devices, water purification, even missiles. Yes, missiles. Every Tomahawk missile has about 500 ounces of silver in its circuitry. Try waging endless wars and green transitions at the same time without silver. Good luck. So when people tell me silver's just an industrial metal, I remind them it's also the most monetary of all industrial metals and the most industrial of all monetary metals. It's both a commodity and a currency. That's why it's so explosive when the monetary system starts to wobble. And right now, it's wobbling like never before. Let's look at some perspective. In the 1970s bull run, gold rose 2,300%. Silver rose over 3,200%. In other words, silver didn't just follow gold, it outran it. That's because silver's smaller market makes it far more sensitive to shifts in investor sentiment. Once the big money decides to move in, there simply isn't enough supply to absorb it. That's what we're seeing now. Central banks are buying gold, institutions are starting to dip into silver ETFs, and retail investors are finally waking up. We've already seen premiums on physical silver coins and bars widen dramatically. Some dealers are charging 25 to 40% above spot price, and people are still buying. Now here's the fun part. You know those 8 or so Western banks that have been manipulating the silver price lower for decades through concentrated short positions? Yeah, those same guys who got caught spoofing the market and paid nearly $1 billion in fines? They're trapped. The paper short game doesn't work when people start demanding delivery. It's like musical chairs, except there are 1,000 claims for every real ounce of silver sitting in a vault. Once a few players decide they want the actual metal, not the paper promise, the whole thing unravels. That's exactly what's happening in both London and New York. The COMEX, which used to be the center of global silver trading, is seeing record deliveries. Contracts that used to be rolled over for cash settlement are now being stood for physical delivery. That's a fancy way of saying, no, I don't want your paper. Send me the metal. And the biggest players doing that? Not retail investors, not meme stock traders. It's sovereigns, industrial buyers, and global South nations. The same countries that are tired of being bullied by Western monetary policy. They're saying, if you're going to weaponize the dollar, we'll de-dollarize our reserves, and we'll do it with gold and silver. Meanwhile, Washington's pretending none of this is happening. Janet Yellen keeps talking about resilient labor markets and soft landings, as if the bond market isn't melting down in real time. The federal deficit just crossed $2 trillion for the year, and we still have the fourth quarter to go. That's not a deficit, that's a hemorrhage. And here's the tragicomic part. The Fed is still talking tough about inflation while quietly monetizing debt behind the scenes. They can't actually shrink their balance sheet meaningfully without crashing the treasury market. The same Fed that claims to be fighting inflation is now one bad auction away from another round of quantitative easing. It's like a junkie saying he's quitting, right after taking another hit, which brings us back to 1970s deja vu. Remember, the last time gold went parabolic was when inflation broke loose and the Fed lost control. In 1979, Paul Volcker had to jack interest rates to 20% just to restore confidence. That broke the back of inflation, temporarily, but it also broke the economy. Mortgage rates hit 18%. Unemployment soared. The Dow Jones dropped nearly 25%. Now fast forward to today, the debt to GDP ratio isn't 35% like it was back then. It's over 120%. There's no way the Fed could hike rates to double digits without detonating the treasury market, the banking system, and half the corporate bond universe. So when people ask, could we see another Volcker moment? The answer is no. We can't afford one. The only way out is through inflation. The debt can't be paid. It has to be inflated away. And that's exactly what gold is signaling. When gold moves 54% in a single year, it's not because of Reddit traders or CNBC hype. It's because the market is front-running the Fed's next bailout. It's because real yields are negative in everything that matters. It's because trust in fiat is quietly dying.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.